there's a lot of investment products or financial instruments available. I mean, the list is probably endless. Yeah. How does someone decide what's the best fit for them? What's that process look like?
Yeah. Again, it goes back to making sure that it is that US specific proposition for me, because sadly, where people or US people have engaged and tried to get advice internationally, if we look back over the last 12 years now, since kind of that implementation of FATCA in 2010 and people starting to take notice of it up until kind of 2012, where foreign institutions really cottoned on to what was going on. But you had, before 2010, you had the entire world to talk to as a US person. You had all the financial institutions globally. If you're an expat working in the Middle East, anybody would talk to, anybody would provide you advice, and anybody would take you on as a client. Post that 2010 FATCA initiative, then that world shrank, because those offshore institutions didn't necessarily want to deal with you as a person, because you had that US connection. And much of that planning then went back to the US. But then since 2015, I'd say probably HSBC be one of the first, kind of then the pressure from the SEC and the increased KYC and AML requirements for banking and investment advice in the US, that started to get harder. So the world has started to shrink. So whilst the universe is huge, it's becoming quite constricted. And I think it's probably one of the biggest reasons why, certainly from our point of view, the US expat market is vastly underserved today. But those that have had financial advice, or those that are seeking financial advice, one thing to be aware of is that it has to be that US specific proposition, because taking advice from an individual who doesn't, or a firm that doesn't, and doesn't have access to the right solutions, if you end up with a non-domiciled US solution, so let's take mutual funds for a second. If you're not familiar with what a mutual fund is, it's a collective investment vehicle based on maybe an industry or a sector or a geography. Let's take North America, for example. You could have money invested in a North American mutual fund, and it would be virtually invested in kind of the S&P and the wider market. But if that fund house hadn't based its fund out of America, and it had based itself out of, let's say, Luxembourg or Ireland, for example, two very popular jurisdictions for non-US mutual funds, those are what we would call passive foreign investment companies, or PFICs, right? And as an American, you don't want to end up with one of those. You'll be probably able to tell people more why you don't want to end up with one of those, but ultimately they're just taxed punitively. So really, it's the number one thing from my point of view as an expat. It's probably the easiest thing to end up with, the worst thing as a result, because it's just not good from a tax planning point of view and a financial planning point of view. So that's really something to stay away from. I think when trying to understand what you need to have in your life, it's again sitting down and understanding what part to play that investment vehicle has. So again, I've seen people try and seek advice, a financial planner or a financial advisor or an investment banking, private bank, whatever it may be, whatever kind of scope we're engaging that person on, try and do the right thing. So maybe invest money through US wrappers, for example, pension wrappers, for example, have been quite popular over the last decade or so. And that allows a US person not necessarily to end up with US domiciled assets, but they can end up with foreign or PFICs, but in a wrap scenario, which doesn't cause that tax problem. But what it does is it puts that money in an environment that potentially there's limitations on access and consequences on drawdown. So again, just to kind of simplify that, it's, if you've met somebody or you're talking to somebody who's encouraging you to invest in a wrapper or a structure that allows you to invest in this big, huge universe of investments that are available to so many, just understand what that wrapper is and what the consequences are of doing it. So kind of the second point, the first point is, make sure it's US domiciled. That's the first point. We need to make sure that we've got the right thing in place. Make sure that the structure of what you're investing in is suitable for you. So if it is an offshore wrapper, for example, does it meet your criteria for the future? It might be a US domiciled structure. So, for example, we have various different types of accounts in the US. We have just a general investment account or a brokerage account, right? That's just, you have the ability to put money in and take money out as and when you need to. But then you have Roth IRAs, traditional IRAs, 401ks, 529s, all these other structures. I think it's important just to understand the structure that you're investing through and make sure that you know the limitations of that and what it can and can't do for you. And then kind of thirdly, the last one is, and this applies to all those structures across the board, is, and this is probably the most important one for me, is just understand the investment strategy. So if you have got the right advice and it is US domiciled, so you're investing in US investments, whether it be ETFs or mutual funds or direct stocks, etc., and it's in a vehicle that you want it to be in, so just a brokerage account, understand then how that money is being invested and the journey that money is going on. So make sure your risk profiling around that money is the right one for you. again, I see so many people who, as a knee-jerk reaction, would be quite a cautious investor because it may be their first time investing, for example, but they're investing that money, that specific money that they're taking advice on for their retirement or for a future date, which is, well in excess of 10, 15 years. But taking a cautious approach to that money may not always be the right thing to do. And similarly, people who are very keen on investments, love investing, may take kind of a very high risk attitude to a very short duration. And especially in markets, like this year is not an anomaly. If people are looking at the markets and worrying, guys, be aware, it's not an anomaly. It might be an anomaly in your investing lifetime, but trust me, this has happened 14 times since the 70s, 20 times plus since the last World War we had. We see huge market sell-offs. We know that these things do happen. But just understand how your money is invested, the type of risk associated with the portfolio that you've chosen, and then what you can expect through that journey. And then the most important thing is coming towards that liquidation event and having that, again, that same right attitude and risk associated with the portfolio. So they're kind of the three things. They're not, I can't ever say, you should be solely invested in this or solely invested in that. That's not what we do. We kind of just try and put that plan around that investment. And that's why I said for us, the planning part is the most important part. Investment management comes second, because if you can answer these questions as that client goes through the journey, you end up kind of tailor-makes itself by the time you answer all the questions. But they're really the three things for me. Make sure it's US specific, make sure you know the wrapper or the structure that you're investing through, and then just be aware of the risk profile that you're allocating to that portfolio.
Thank you for that. Again, very comprehensive. I just wanted to talk a bit on the second point you raised about being cautious with products and platforms that may not be US domiciled. And as you mentioned, PFICs, right? The passive foreign investment companies, they are a very specific and credible risk. I mean, just this morning, speaking to a client in Singapore who is about to make an important decision, he's getting married and stuff like that. So he's just going through his affairs. And he realizes that he has PFICs because he invested in products that were pitched at him. And for those who are not aware, I just want to kind of speak to what these acronyms mean. So KYC, those are your customer stuff that the banks take you through. That's why it takes such a long time. AML, anti-money laundering, and PFICs, as we said, passive foreign investment companies. As to the origin of PFICs, they date back to the 1980s under President Reagan. So during that term, we saw the creation of, Section 1297, which speaks to, as Tom said, those collective investment vehicles, where at least 75% of that structure's gross income is passive, or 50% of the assets are investment held to create passive income. So basically, you're thinking in terms of a non-US mutual fund. So sometimes they're called unit trust. And then, as you mentioned, Tom mentioned wrappers. So sometimes something may appear to be a pension, a non-US pension, or some non-US retirement product, or some non-US insurance product. And when, as US tax professionals, we take a look inside, like we did with our client this morning, and then, oops, you have a PFIC. So again, it's really good. I mean, just err on the side of caution and just stick to, as much as possible, if you just want to be super conservative, with US domicile products. But if not, if you want to look outside, then just definitely get advice before you jump in, because the reason why PFICs were created was because the US domestic financial institutions began complaining to Congress that, hey, Americans were getting an advantage by investing outside of the US. They're getting a tax advantage. Basically, they don't pay tax until there's a distribution way at the end. And that put these foreign products at an advantage compared to US domestic products, which is unfair. So the IRS, when we talk about PFICs are, a bit aggressive, and they are aggressive by design. So it's a section of the tax code that penalizes you as a US exposed person in investing in that foreign collective investment vehicle if it does trigger PFIC status. So to your point, definitely keep an eye on them, get advice, and maybe it's best to stay away depending on your situation.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.